So this is part number 31 of this multi-part video series on stock trading for positional stock traders. In this video, I want to help you further understand the importance of identifying or assessing risk in a particular base. Now, you must have heard me talk about early stage base, middle stage base, late stage base. Early stage base is base 1, base 2. Middle stage base is base 3. And late stage base are base 4, base 5. Anything beyond base number 5 is super late stage base. I have seen bases go up to base number 9. I have even seen base number 10 and a stock breaking out of base 10. But in general, base 1 to base 5 is the normal price action. And after every base, the stock breaks out to go up 20 to 25%. That is normal price action. So from base 1, it should go up 20-25%. Then it forms base 2. Then it again goes up 20-25%. Then it again forms base 2. And the period from base 1 to base 2 could be anywhere between 6 to 24 months. That's the general time period during which all of this price action happens. Okay. Minimum could be 6 months. Maximum could be 24 months. That's generally being observed in leading stocks. Now, have a look at this. This is REC Limited. As per the SEBI regulations, I am using old chart example. So this is 8th of January 2024. As you can see, this is a flat base. Okay. Just because a stock is in early stage base does not mean that your risk is low. Let me repeat that statement. Just because your stock is in early stage base does not mean that the risk in that base is low. Let me explain. Okay, now this is a flat base. Now, I have been telling you no need to go into the definitions of the bases because these bases are already marked on the market Smith chart. Even the pivot point is marked on the market Smith chart. So you don't really need to go into the definitions of these bases. However, if you want to become a sophisticated professional positional stock trader, it will definitely help if you truly understand what a base means and how it is constructed. If you understand how a base is constructed, okay, or marked by MarketSmith itself, that will further help you deeper your understanding of the risk inside the base. Okay, so for those of you who don't want to go into too much details, you can stick to MarketSmith pivot point and the base marking. But if you truly want to understand the risk, you need to pay attention, because if you are committed to professional positional world class stock trading, you need to understand what you're doing. So if you read William O'Neill's book, he says that a flat base generally occurs as a second stage base. So this is base number 2. Even on MarketSmith, this is marked as base number 2. It consists of tight price action. Okay, so this is tight price action. Look at the closings. Look at the spread of these candles. So closings are very tight. Generally, it is 5 to 6 weeks. Now, this is 4 weeks. Now, just because it is less than 5 weeks doesn't mean that it is not a flat base. It is a flat base with 4 weeks of consolidation. However, the risk in 4 weeks of consolidation is slightly more than the risk in 5 weeks of consolidation. It is as simple as that. Flat base is generally 5 to 6 weeks. And it comes normally in second base, base number 2. After it breaks out of base 1, like a cup with handle or a double bottom or a saucer with handle, it breaks out of that, goes up 20-25%, and then it forms a flat base. However, please pay attention to this chart. Okay. As per my understanding or as per my base counting method, I look for a candle or a bar after which there should be 3 consecutive bars below the high of this bar. So you look at the high of this bar. There are 3 consecutive bars below the high of this bar. That's when the base actually begins. Okay. Now you go back from here when the stock broke out. See, after this long base cup with handle, when the stock broke out here. Okay. After that, tell me one bar after which you have 3 bars which have closed below the high. So if you look at this bar, no. Even this bar, no. Even this bar, no. So after the stock broke out from here in this area, this is the only bar after which you have three consecutive bars which are below the high of this candle. Please rewind it and listen to what I said again. After the stock broke out from here, somewhere in this area or somewhere in this area, okay, I think that was the breakout. After this breakout, there is not a single bar after which you have three down closings or three bars which are completely below the high of the previous bar. So this is the only bar. Okay. If you want to learn more about this, look at my base counting video. Okay. So after this breakout that happened here, somewhere here, if we measure the distance, see, let's say the breakout happened here. After this bar, there are three consecutive low bars. So you consider this as the pivot point. You see the stock went up 200%. That is not normal price action. We want normal price actions to be 20-25%, after which we want the base to form, right? But here the stock never formed a base. After it broke out here in 29th of May 2023, the stock never formed a base, right? And went up 200%, which means what? The stock got extended. So even though this is base number 2, you can't say that this is early stage base. Okay, early stage definition is applicable when the stock is displaying normal price action. See, by the time the stock goes up 200%, it should have created 4 or 5 bases. But in this case, from base 1 to base 2, it is 200%. Right? So you understand what I'm saying? Just because it is base 2 doesn't mean that the risk is low or you are buying it early. Boss, you are not buying it early. You are buying it after the stock has shot up 200% in 3 months. Correct? A stock going up 200% in 3 months, that's an extended stock. That doesn't mean you have to buy at base 2 and you still could hope to make money there. Okay. Let's draw the pivot point. So the high of this candle is 454.75. Okay. So 454.75. That's the pivot point. Then I have the calculator here. This is 454.75 multiplied by 1.05. That is 477.48. Okay, the style will be blue. That's the buying range. Then we draw the selling range. Green color, 454.75 multiplied by 1.2. 545.70. 545.70. This is 454.75 multiplied by 1.25. That's 568.43. 568.43. That's your selling range, correct? Then stop loss 454.75 multiplied by 0.92. That is 418.37. 418.37. And this is 454.75 multiplied by 0.95. 432.01. 432.01. Style is red. Stop loss range done. So buying, stop loss and selling zone all marked. Let's see what happens. I will move the week forward. Look what happened. See, did it close below the 10-week simple moving average? Yes. On these 4 weeks, did it close below the 10-week simple moving average? No. But see, after the breakout happened, this was the breakout week, right? After the breakout happened, that means you would have bought on this in this week, correct? In this week, you would have bought the stock. In this week, your stop loss would have been hit. Okay, that's what I'm trying to tell you. A flat base is a good base. So there are two levels of risk that you need to understand here. The first level of risk is the stock is extended in price. After base 1, it should have gone up 20-25% and formed a flat base. In the definition of a flat base, in William O'Neill's book, he writes, the stock should go up at least 20% or more before it forms the flat base. Or more doesn't mean 100%, 200%. Okay. Around 20-25%, after which it would be understandable if the stock is forming the second base. Okay. So that is one level of risk. The stock is too extended in price. Number two level of risk is a flat base is consist of at least 5 to 6 weeks. This has got only 4 weeks. Okay. So that should give you a clue that there is additional risk involved. Your flat base is shorter than the definition given in William O'Neill's book. See, just because it has got 4 weeks doesn't mean that it is not a flat base. It is a flat base, but it's a slightly risky flat base. Moreover, what else do you look for in a flat base? Whenever there is a red bar, you look at volume. The volume, as long as it is low, there is no problem. Okay. So ideally, when the stock falls in the flat base, it should fall on low volume so that it represents retail selling. Moreover, the correction in the flat base should be around 10 to 15%. In this case, it is 16%. So 1% here and there is fine, but still, if it is more than 15%, you know that there is slight risk involved in that stock. Correct? So going by the textbook definitions, there are 2, 3 violations here. Okay, which adds to the level of risk. That doesn't mean that it is not a flat base. It is a flat base. Okay. And since we have the understanding of the risk now, it makes sense to either not take a trade, or if you are taking the trade, go in with a small position size so that you don't end up losing money. Of course, you will lose money in this particular week. Your stop loss will get hit, and the stock never reached the 20-25% selling zone. Correct? Why did that happen? That happened because of this prior run, because of this prior extensive run after the breakout happened on 29th of May 2023. See, from here till here, like this bar from 29th of May week till 11 March 2024, almost 7 plus 3, 10 months, the stock continued to remain above that 10-week simple moving average. In this week, it tried to close below that, but it did not close below the 10-week simple moving average. And even if it had closed, it was not a worry because the volume on that week was very low. If it closes down on high volume, that's a problem. Here it closed it down on high volume, that is a problem. Okay. So you understand, just because you are buying base 2 as per market Smith, you are buying a flat base as per market Smith, you are buying the correct pivot at the correct pivot point as per market Smith, you are doing everything as per market Smith, you'll still end up losing money because you don't get the complete context. Okay. And there are people who try to automate this system. Okay. They write Pine script code and trading view and what not people do. See, these are the things that you cannot code. These are the things that you can only see with the human eye and understand the risk involved. That is why I say don't spend time on automation. Spend time reading books by William O'Neill, okay, and observing the charts. The whole game is about understanding risk. If you can understand risk inside the base, look at price, look at volume, look at the color of the price and volume bar, look at the number of weeks of consolidation, look at the prior price action, look at the base count. If you look at all these things, liquidity, comparative, technical, fundamental, market, when you look at all of these things, you get a clear understanding of the risk that you are presented with. You go to a restaurant, you are presented with a menu. You look at the menu and then you select the dish that you want to order. Similarly, when you open Market Smith filters, you get a menu of stocks. You look at the entire menu and then you pick the stock that you like. That is the exact approach that you have to use here. So you have to be able to assess the risk that has been presented to you. And I am telling you that before even the stock breaks out, the chart gives you enough clues as to how much risk there is. The chart tells you what's the probability of the stop loss being hit. In this case, the probability of stop loss being hit was high because the stock already ran up 200%. Imagine those buyers who bought the stock at base number 1. They would love to sell the stock at 200% return. Okay. So please understand that just because you are buying base number 2 doesn't mean that you are taking lower risk. Okay. That's the point I wanted to convey in this video. I hope this was helpful. So you are a risk manager. You are not a trader. You are really a risk manager here. Okay. Thank you so much.